let's get right into it. What we're doing here is correcting a huge mistake I see traders make all the time. We're going to stop chasing random signals on indicators and start building a real, structured, rule-based approach. The goal is simple: get rid of the guesswork and replace it with a clear process you can repeat. We're going to take a very common tool, the 20 EMA, and finally learn how to use it the right way.
Okay, take a look at this chart. Price is pulling back to a moving average. You've seen this 1,000 times, right? Now, the most common impulse, the wrong impulse, is to see this and think, aha, that's my signal. So, let me ask you straight up. Looking at this, is it a signal to buy?
The answer is a hard no. If your first thought was yes, then this explainer is absolutely for you. We're here to break down that gut reaction and rebuild your thinking from the ground up, based on logic, not on hope. So, what's the real problem we're trying to solve here? It all comes down to understanding the difference between a signal and context. Getting this wrong is, frankly, the root cause of most inconsistent trading, and we have to fix this before we can make any real progress. And there it is, the fundamental error. Indicators are not your crystal ball. They don't give you buy or sell signals. Their only job is to provide some context for the price action you're already seeing. When you treat them like an entry trigger, you're basically handing over your decision-making to a lagging formula. And that just invites randomness, which is the very thing we're trying to eliminate. So, if indicators don't tell us what to do, what does? This brings us to the absolute foundation of this entire framework. It's non-negotiable. Before you even think about looking at an indicator, you have to look at one thing first: the price itself.
I want you to burn this into your brain. This is the #1 rule that governs every single decision from here on out. Think of it this way. The indicator is just an employee. Price is the boss. The employee might have an opinion, but the boss always makes the final call. Nothing else matters more than price structure. So how do we listen to the boss? We learn to read its structure. Let's walk through the simple mechanical steps to identify an uptrend. First, we find a clear low point. That's our starting line. Second, price has to move up and make a high that's obviously higher than any recent highs. That shows us some initial strength. Third, and this is the key part, price pulls back, but it stops at a higher low. It doesn't go all the way back to the start. This shows us that buyers are stepping in sooner. And finally, for confirmation, price has to break that last high to make yet another higher high. See that? Higher highs, higher lows. Notice we did all of that without a single indicator on the screen. This is the skill.
All right, now that we've established that price is king, and only now can we bring the indicator back into the picture. It's time to define its real job, which is a limited but helpful supporting role. We're just going to use one tool for this, the 20-period exponential moving average, or EMA, on the daily chart. Now, look at this definition. We don't care about the complex math behind it. What we care about is what it does for us. Its only job is to help us see the rhythm of the trend and judge the quality of a pullback. That's it. Nothing more, nothing less. Let's make this crystal clear. On the left, you've got the wrong way to use it, hunting for signals, looking for a trigger, letting it overrule what price is doing. That's reactive. On the right, that's the correct use. It's analytical, it's just a helper, it's a tool that provides some context for what the boss, price, is already telling us. Okay, let's put this into practice. How do we actually use the EMA to judge the quality of a pullback? We're going to create a really simple black and white framework. A pullback is either clean or it's messy. There's no in between. This is a clean pullback. This is what we're looking for. See how price just kind of drifts down toward the EMA, but it pauses and holds above it. It respects that area. The whole move is controlled and orderly. This tells us that the buyers are still very much in charge of this trend. And then there's this. This is a messy pullback, the scenario you have to learn to avoid. Here, price shows zero respect for the EMA. It's just chopping right through it, back and forth. There's no clean pause, just a lot of noise and indecision. In this case, the EMA isn't acting like support at all. It's acting like a magnet for messy, unpredictable price action. And that's our signal to stay away. This brings us to another super important rule. It's not just about telling good pullbacks from bad ones, but also about recognizing when there's no pullback at all. So when is there simply no valid entry opportunity on the table? Here's the answer. If price is screaming higher, way extended and far above the EMA, that is not a sign of strength you should jump on. It's a sign that you are late to the party. An extended move without a controlled pause is not a pullback, and the rule is dead simple. No pullback means no entry. Period. This one rule will save you from chasing trades right into a top. Now for a really crucial skill, knowing how to spot failure conditions. Understanding when your tool isn't working is just as important as knowing when it is. Knowing when not to trade, that's what separates professionals from hobbyists. Here's your objective checklist. If any one of these things is true, you reject the setup and walk away. First, if price is messy and just slicing through the EMA over and over, reject it. Second, if that EMA is clearly acting like a magnet for choppy price action, reject it. And finally, this one is critical. If the trend on the higher time frame, the weekly chart, is going in the opposite direction of the daily trend, you have to reject it. A perfect-looking daily pullback doesn't matter if it's swimming against the bigger tide. This is what builds discipline. All right, let's wrap this all up. We're going to restate the core principles of this whole framework. This is the decision-making hierarchy that you need to internalize so this lesson actually sticks and your process stays clean and objective. This is the first big, powerful rule to take away. If you ever find yourself staring at a chart, trying to use an indicator to convince yourself that a trade is a good idea, you've already lost. The justification has to come from the price structure itself. The trade should be obvious from the structure long before you ever glance at an EMA. And we end with the single most important mantra of the whole day. This one little phrase sums up the entire hierarchy. Price leads, the indicator follows. Always, always remember who's in charge. This is the very core of a logical, rule-based approach to trading. So I'll leave you with this final question to ask yourself. After what you've learned today, take a hard look at your own process. Are you still just hunting for blinking lights and magic signals from indicators? Or are you ready to do the real work, the work of learning to read the structure of the market itself? Your answer to that question is going to define your entire trading journey.